Plan for the worst, hope for the best. Under-promise and over-deliver. Measure twice, cut once. What do all these sayings have in common? They're about building in margin for error, which we do a lot in our retirement planning. Margin for error is everything. When I'm working with clients, whether they're 45, 55, or 65 that are dreaming about retirement, we have to acknowledge the pitfalls of planning for 30, 40, 50 years into the future. There are so many unknowns. The things we do know are that markets will change, your spending habits will change, and really the world around us will continue to change. So the goal isn't to create a perfect retirement plan. Rather, it's to create one that provides flexibility to navigate whatever the world will throw our way. I like to think that retirement planning is like a cross-country road trip from DC to LA. When you plug the directions into Google Maps, it's gonna first give you a ballpark ETA when you first start driving. But of course, that's gonna be way off. And by the time you get closer, Google Maps is gonna give you a much more accurate ETA once you get into California. Retirement planning works the same way. You need a place to start, kind of a compass, a direction to head towards. But then as you get closer to retirement, and especially the year before you retire, we need to make a lot of adjustments to ensure that our T's are crossed and our I's are dotted. A retirement plan should be a living, breathing document. I've seen folks think that the first time we go through a retirement plan, they act like it's carved in stone, but really it should adapt over time. We've all seen the confidence dial, the retirement confidence dial, and it goes from 0 to 99. I've seen big moves change over time, just as spending changes, markets change, returns have made a big impact on their portfolios. And that's why we need to rerun these retirement plans pretty often. Because the things we know is markets don't move in straight lines. They just don't. Inflation doesn't stay constant. Hello, 2020, 2022, 2023. Your lifestyle and spending will evolve. You may be spending more in your early age of retirement and much less once you age and you can't do as much activities or traveling. And then the other unknown is really just how long will you live? We have to make some type of an assumption, but as medicine and science continues to improve, folks are living longer. So we have to stress test for a longer lifetime in the retirement plan. So let me show you what this looks like in a real situation. First off, you start with your base retirement plan, but then we need to run some stress tests to see how the plan holds up under different scenarios. Now we're looking at a sample retirement plan. Under the current plan, you can see we have a 49% probability of success. And what this means is that if all the stars align, all the data points we put into this retirement plan work exactly how we wanted it to, then there's a 50% chance that this plan will work. There will be money left at the end of the day. But there's also a 50% chance that these folks are gonna need to make some adjustments down the road. And so 50% is probably not cutting it for a successful retirement plan. Now you can see here on the proposed side, we've got a much better retirement score at 80%. Now when your retirement plan doesn't work out, you've got a handful of ways that you can increase the confidence score. A lot of this will be adjusting your spending in retirement, maybe saving a little bit more while you can. We could downsize in the plan and utilize some of the equity to bolster your portfolio, change your Social Security timing plan, etc., etc. In this plan, we optimized their Social Security claiming strategy. We increased their retirement date from more early side 62 to 65, and we actually left the spending as is. Now, an 81% is a great start, but what happens if markets don't behave exactly how we want it to, or Social Security ends up getting cut by 20%? That 81% is for sure gonna change. That's why we need to stress test the plan to see how resilient it is. Now that we have a successful retirement plan, we can stress test this through an analysis. So on that far left, we have our baseline at 81%. And then we have different factors that we can edit to see what the impact would be if markets drop immediately, or taxes are higher, or Social Security gets cut. And we can see down below, these are the factors I have. So equity markets drop 20%. Social Security will be reduced by 20%. Inflation is a whole percent higher. your market returns will be lower by 1%, or taxes are higher by 20%. You guys live an extra 5 years than we're estimating, or healthcare costs become a lot higher. Through this analysis, we can see what the pitfalls would be, or things that we need to be aware of, and make adjustments while we can to account for it. So we can see, for example, if markets drop immediately, these folks are still about 5 to 10 years out from retirement. So that's not going to be a detriment to the portfolio. Yes, it drops the percentage from 81 to 73%, but that's still a doable plan. Whereas if Social Security gets cut by 20%, that's going to make a significant impact to that confidence rating from an 81% to a 66%. So we need to be flexible and adjust if something like that happens. And the Social Security Treasury is set to run out by the early 2030s. If that actually does happen and benefits get cut by 20 to 25%, then we'll need to make adjustments, whether it's saving more, spending less, maybe retiring a little bit later. We'll just have to make that adjustment when that time comes and we have information available. On the other hand, we can see that living an extra 5 years and spending more of the portfolio, there's still enough left that there's a strong 77% chance that this plan works exactly how we want it to. In reality, these are kind of the worst case scenarios. More than likely, some of these will happen to some extent, but then on the other side, other things may happen that are good or work towards building a better retirement plan. So maybe Social Security gets cut, but asset returns are much higher than we were expecting. Or inflation's higher, but taxes get cut down the road. There are trade-offs, and that's why we want to build a flexible plan. Here's the thing. No advisor will know what your retirement will exactly look like. But the principles of living below your means, building a solid nest egg, planning ahead of time, and being flexible remain timeless. So if you're getting close to retirement, let's say within 5 to 15 years, ask yourself, has your plan been stress tested? Would your plan hold up if one of those variables happened? Markets perform worse than expected, inflation's higher, or Social Security gets cut. If that did happen, what changes would you make to succeed in your retirement plan? See, the key is to have a backup plan before a shift is needed. These are the type of conversations we have with clients all the time. If you feel like you're on the right track, but just aren't sure how resilient your retirement plan is, we're here to help. We help you run through the numbers, test different scenarios, and create a plan that can navigate whatever markets throw our way. After all, money isn't just about doing what's most optimal to build the biggest nest egg. It's about finding balance to live the most fulfilling life you can. If you have any questions, feel free to reach out to questions@FSAWealthPartners.com or give us a call at 301-949-7300. We'll see you in the next video.